bit there, but we're getting going here, and I want to introduce our presenter today, Chad Abbas, with the accounting, CPA, and consulting firm Bergan KDV. I asked Chad beforehand how long he'd been there and if I had to introduce any of his former life, but luckily for me, he's been there since he got out of school, which was at UNI. So we're always excited when we can feature an alum on our program. And anyway, with that, I know we've got about an hour to talk about tax tax avoidance. And I've been working on that joke all week, so I hope I went over well. Anyway, I want to turn it over to Chad to start kind of getting into this, but the whole reason for this is that tax mitigation is obviously a big part of succession planning and exit planning for business owners, and so we wanted to feature something on this week, and thank you all for being here. So with that, go ahead.
All right, thanks, Dan. Appreciate the introduction. Like Dan said, my name's Chad Abbas. I'm a 1991 grad from UNI, proud accounting alum at UNI. I'm a tax partner in the Bergan KDV Waterloo office. So with my 27 years of experience, I kind of developed an areas of expertise in the manufacturing, distribution, dealership, real estate, and service business. Clients ranging from anywhere from a couple $100,000 of gross receipts to as high as $500 million of gross receipts. In the information that I've put together in a PowerPoint that I understand will be forwarded to you after the webinar is my contact information and all the slides and everything too. But obviously, open forum, so any questions that you have, certainly submit, and we'll try to answer them as quickly as possible and as accurately as possible. As we start talking about mitigation during exit planning, tax mitigation during exit planning, the overall goal in exiting a business, I think everyone would agree with, would be to have as much as possible, keep as much money as possible after taxes as you leave the business. And so there are really two ways to accomplish that. One is, of course, the maximization of the sales price, and the other is the mitigation of income taxes. So just briefly, and I know that there's other webinars that'll talk about business valuations and the like, I'm sure. But when we talk about the maximization of sales price, many times what business uses as a sales price is a capitalization of cash flows, where they're looking at the cash flows that the company is producing. And so then to that point, the value is usually based on what the future cash flows are predicted to be in a company. In trying to predict what those cash flows are, we certainly look at the history of how the company has performed as an indicator of what the future performance is going to be. So to that point, the greater the success of your history or the recent history of your business, that certainly would lend credibility to the future cash flows that you're going to include in the valuation, and thus have a higher valuation, have a higher sales price as a result. So just a little bit on the maximization of the sales price is trying to, get some good years in there before you're ready to sell. When we turn to the mitigation of the income tax piece, however, there are many different issues to consider on that front. First of all, would be the entity type, and related to the entity type is whether it's an asset sale or a stock sale, and we'll get into all these categories here. Second item that would be a consideration would be the allocation of the sales price. Third item would be the potential to do an installment sale in selling the business. Another item would be in Iowa here, we are fortunate to have what they call an Iowa capital gains deduction, which provides some Iowa tax relief on the sale of a business, potential tax relief anyway. Another option that you've probably heard a lot about, and I think is going to be covered in another webinar, is employee stock ownership plan, an Esop. Another item would be that's gained popularity as C corporations are beginning to gain some popularity as well, is a Section 1202 stock, and we'll talk about what that is. Next item would be personal goodwill and allocating that in a sale and trying to carve out some income in that regard that would be related to the business owner and personal goodwill that that individual brings to the business. Next item would be complete liquidation and being able to capitalize on some opportunities that would result in a complete liquidation. Next item would be a structured S corporation stock redemption for those of you that might be S corporations. And then the last factor that we're going to cover today is certainly the age of the owner. And there's certain reasons why it may or may not be advantageous to sell or liquidate a business based on the age of the owner. So we'll dive into those categories. And the first one that we'll start with is stock versus an asset sale. And again, this is a big category for C corporations primarily, but it can pertain to S corporations as well. In a stock sale, there is one layer of taxation. What that means is just like an individual, you may own shares of Pepsi-Cola stock. When you sell that stock, you have a gain on the sale of that stock, the difference between what you sell it for and what you purchased it for. Pretty straightforward. It's a capital gain. And we'll dive into capital gains versus ordinary income, but it's pretty straightforward. Pepsi-Cola, in this particular case, continues on doing normal business in their corporation with really not any change to their operations at all. I mean, really no changes to their operation at all. So the buyer steps into the shoes of the seller when you sell the stock of a closely held business. And so the business continues as it already was set up. Conversely, if you have an asset sale, first of all, there's a double layer of taxation. So under the stock sale, when you sell the stock, like I said, it's a sale by the individual shareholder. In an asset sale, the corporation is selling the assets of the business. So there's a gain at the corporate level that creates tax inside the corporation. But that money is stuck in the corporation. In order to get that money out to the individual shareholder, that money has to be distributed out, and that creates a second layer of taxation. So in a C corporation, many times you'll hear about double taxation, and that's being a concern and an impediment to being a C corporation. And that's exactly why, is because there's two layers of taxation. Conversely, also to a stock sale, when a buyer has an asset acquisition, they buy just the assets and they form a new corporation that they have or a new entity that they have. And they don't automatically, they're not going to step into the shoes of the former business owner. And that's important from the standpoint of liabilities that could exist with the former business. That, you don't want to take on liabilities that could have existed, 3 years ago. And then also it allows the business buyer to begin to depreciate the assets, be it equipment, be it goodwill, be it whatever the case may be. It allows them to depreciate that purchase price and get a deduction for it. When you buy stock, it's pretty much a dead asset until you sell it. So when we look at a stock versus an asset sale, as a seller, if you're in a corporation or an S corporation, you would much rather have a stock sale because of the single layer of taxation. But if you're a buyer, you'd much rather have an asset purchase. Consequently,
I'm guessing most of the time it's an asset purchase.
In a closely held business, it is usually an asset sale.
Okay.
Absolutely right, because the buyer is not going to want to step into those shoes of the seller, and they're going to want to depreciate those assets that they're buying. So it's far more attractive, and that tends to be the way that things lean when you have an asset sale.
When do you see Founder Frank being able to talk the buyer into a stock sale?
Usually, in order to talk the buyer into a stock sale, you're maybe foregoing some of the purchase price.
Okay.
And so that's where you have to balance. What are you foregoing in a purchase price, and do some projections to determine what you're going to have after taxes in an asset sale versus what you would have after taxes in a stock sale with a reduced purchase price, with a reduced sales price. So those are different factors, but it's difficult to move the needle unless the buyer feels like they're getting something in return.
So
because of that risk factor.
if you're willing to give up some of that top line valuation of the firm, that's basically where it ends. Is the
That's
money
correct.
has to talk there for the buyer to be intrigued by that. Is that a lot of times buyers are financed. Most of the time buyers are financed. How does the bank look at things, or how do they get involved in talking the buyer's ear as far as that goes?
Yeah, generally speaking, they're not as concerned. However,
Okay.
it's easier for them to loan the money to a company that's buying the assets,
Yeah.
as opposed to loaning the money to an individual shareholder who's buying the stock.
Okay.
If they loan the money to the company, they have all the assets in
Sure.
that company as collateral.
Yep.
And they can certainly tie the assets of the company to that as collateral. But that loan is in the business where the operations are, where the cash flow is.
Mm-hmm.
It lends to being able to pay back that debt much more favorably.
Okay.
Whereas if you have the debt individually as a stock ownership, it's really outside the company. And so how are you going to fund the money to be able to make that debt payment?
Right.
You're going to have to take dividends maybe out of a C corporation, which isn't necessarily favorable because it's going to create tax ramifications to that. And also it takes money out of the business that
Sure.
could be left in there to
Cash
fund the
flow,
operations.
starving the cash flow a little bit.
Right.
Okay.
Right.
So, I mean, if you were to advise Founder Frank on, is that, so while that's an option, it's only an option when you're willing to give up some valuation of the firm. And have you seen it used?
Yeah, I've seen it used before. A lot of times what will happen is, you'll start at the stock and then they'll, lean that direction with some consideration given in essence.
Okay.
But I would not give that up front. I would try
Use
from the
it as a
get-go
negotiating
to have
tool.
a stock sale, but you have to understand that it's going to be difficult to have a stock sale in a closely held business.
All right.
There are certain factors that certainly could lend itself to that, but generally speaking, they're going to want a fresh start
Okay.
and have an asset purchase.
Okay. Thanks, Jeff.
Yeah, you're welcome. The next item that we had on the topics as far as what to consider for tax mitigation would be the allocation of the sales price. And this is probably more important for an S corporation or for an LLC owner.
Okay.
And so from the standpoint of the allocation of the sales price, what we're really looking at there is we're trying to separate the sales price into the different components that make up that business.
Yep.
Those different components will be, anything from equipment to real estate to the goodwill of the business.
Yep.
So capital gain assets, we'll separate them into capital gain assets and ordinary income assets. Capital gain assets are really going to be your goodwill or the blue sky, as many of you have probably heard of it. Those are your intangible assets. It may be the reputation that business has grown over the year. It may be the employee base that business has.
Mm-hmm.
It may be the customer base that business has.
Sure.
It's the general intangibles that has made that business successful, has made a name for that business. And there's a lot of value in a successful business tied into the goodwill and the blue sky. Another capital asset would be real property. That would be your real estate, your land, and your buildings.
Okay.
Those would fall into what we call 1231 assets, but gains from those can create capital gains. And the importance of capital gains is that if you hold them for at least 1 year, it's considered a long-term capital gain, and you get tax-favored rates for the sale of long-term capital gain property as opposed to ordinary income property. So the federal capital gains tax rates on long-term capital gains can be 0%,
Sweet.
15%, or it could be as high as 23.8%.
Mm-hmm.
And what that 23.8% quickly comprises of is there's a 20% capital gains rate, but then there's a 3.8% investment income tax, which is a Medicare surcharge as part of Obamacare.
That's
that came
the
into play.
Obamacare fee?
Exactly.
Okay.
And so that's how we get to 23.8. So if you're in that 20% category, you're really going to be paying 23.8 as a result.
How do you get to zero?
Zero is based
Trying to evade taxes.
Yeah, exactly.
Come on, Chad, help
So,
me out.
yeah. So zero, if you're able to keep your income in what used to be called the 15% tax bracket,
Okay.
it's approximately $77,000 of income or less.
Okay.
Your capital gains are taxed at a 0% rate.
Okay.
Then when we get to a 15% rate, there's a span of income there that you're in a 15%. And then at your highest rate, you're at that 20% plus that 3.8.
Okay.
So again, it depends on how much income you have, both from other income that you generate on an annual basis, but also how much income is being generated from the sale of the business.
Okay. We'll probably talk about it later, but is that part of where the installment plan comes into play?
Absolutely. It would certainly be a factor that would help keep your tax bracket, keep your taxable income in these favorable tax brackets.
Okay.
And so, again, there's no guarantee that it would work, but it's something that needs to be analyzed.
So the Goodwill Blue Sky bucket, that's always going to be at your income tax bracket level. There's no capital gains component there, right? So you're
there's a
no
capital
cost
gain
basis,
yeah.
right?
There can be cost basis. If you acquired the business and bought some goodwill in that, you certainly could have some basis there to offset against it. But you know, in a business that's generated from scratch, generally speaking, you're not going to.
Okay.
But absolutely, there's going to be capital gain there. And the real property, I should add there that the depreciation is actually recaptured at a 25% rate, max 25% rate. So if you're in a bracket higher than 25%, that depreciation that you took on that real estate, if you recapture that as part of the gain, it's only going to be taxed at 25% as opposed to, say, 37% if you're at the top rate.
So that's where we can also do some tax evasion, is if we've been depreciating the building or some expensive equipment over time, and when we sell Founder Frank's lemonade stand, we can value the lemonade stand itself at something higher than what we've depreciated it down to. Then we can report that gap back in and hide some of the value of the firm within that.
Correct.
Correct?
Yep. Okay. Correct. So let's segue it.
Who gets to say how that happens? You know, what's to prevent me from putting none of the value into Blue Sky and all the value into.
Yep. So what really how you determine that is really the agreement between the buyer and the seller.
Okay.
And so as in a typical purchase agreement or a sales agreement, there is generally going to be an agreement as to the allocation of purchase price. Okay. Now, as that purchase is or sale is a smaller dollar amount, it may not be contemplated or messed with, really.
Okay.
But generally, we're going to encourage you to come up with an agreement on how that allocation is going to be between Blue Sky, equipment, real estate, whatever the case may be there, because the buyer and the seller technically need to be filing a form in your tax return, an 8594 form, that separates out the purchase price into different categories.
Okay, so
and the IRS matches those up between the buyer and the seller. And so that's where, if you have it in the agreement ahead of time, you don't have to worry about determining what that allocation is later. And what did they...
How was buyer bill?
Exactly. What did buyer report on that form as well?
Okay, so, cool. Thanks.
Yeah, not a problem. So on the opposite end of the spectrum, we have the ordinary income assets. And those ordinary income assets would include inventory, accounts receivable, and then equipment primarily. Equipment, certainly, business that's capital intensive, there's going to be a lot of equipment in there. A lot of that equipment has been depreciated down. So your undepreciated cost compared to what you're selling it for creates ordinary income in that regard. And that ordinary income is taxed at anywhere from a 10% rate to as high as a 37% ordinary tax rate now. So again, the ordinary tax rate is always going to be higher than what the capital gains rate is, because if you're in that 10% ordinary income bracket, you're going to have a 0% capital gains rate.
Okay.
If you're in the 37% ordinary income tax bracket, your capital gains rate is going to be that 23.8%.
Okay.
Now, another piece that becomes important, or that is great in regards to a C corporation, is negotiating a non-compete agreement. And when I say negotiating it, if you plan to start another business, you may not want to have a non-compete in your agreement.
Let's say I'm 75 and I'm ready to head to Fort Myers.
Exactly. So at that point, you're ready to get out of the business, not continue as is.
Yeah.
So in that particular case, you can assign part of that sales price to a non-compete. And in a C corporation, that's important because that non-compete is money that goes directly to you as the seller.
Okay.
And so
it bypasses the double taxation.
exactly right. That money goes to you. Good job.
All right.
And so as a result, it goes directly to you. It doesn't get taxed in the corporation. It's taxed once.
Okay.
Exactly right.
Okay.
Dan, you had mentioned earlier installment reporting.
Yep.
And so installment reporting, this relates specifically to capital gain property. Unfortunately, if we have the sale that's ordinary income property, that gain needs to be picked up entirely up front, even if all the proceeds are not received up front. Okay. So when we talk about equipment, if you're selling equipment and that's all you have to sell, it really doesn't do you any service and any favor to have that be an installment sale, because of the fact that you're going to have that gain entirely up front, and those taxes are going to be due entirely up front, and you're not going to have the cash flow from the entire sale to pay for those taxes.
It's about paying you off
over time. Exactly right.
Okay.
So where the installment gain or where the installment reporting comes in great is obviously, I guess I should give a little bit more background on the installment sale. Say you're selling the business and you're basically being the financer for the purchaser. So you're going to sell that business over the course of, let's just say 5 years. So you have equal monthly payments that you're going to receive over those 5 years. And so you're picking up that gain as a percentage of how much proceeds you receive each year from the total purchase price.
Right.
So with that, you're spreading out that tax over time, and you're able to take advantage of, like you said earlier, let's say you have a business that you're selling for $500,000. And let's say the majority of that is Goodwill and Blue Sky.
Okay.
Let's say your basis in it is only $100,000. So you have a significant gain here of $400,000.
Basis is what I've paid for the stuff in my lemonade stand.
That's correct. And we're assuming that this is all capital gain property right now.
Yeah. Okay.
Instead of having that $400,000 gain all in 1 year, and you would quickly be out of that 0% rate, and you'd have a good portion of it, taxed at the 15% rate.
Yeah.
If you spread that out, say you have a 10-year installment sale, you spread that out over 10 years, you're then picking up approximately, you're getting principal slower on the front end and quicker on the back end, but approximately $40,000 a year is what you're going to be getting as capital gain.
Right.
So with that $40,000 per year, if that was the only income you had, you'd be able to stay in the 0% tax rate.
That's what I like to hear.
Yeah, exactly. Now, you would have interest on that contract as well. Sure. You would negotiate interest. That certainly would be taxable. And depending on how good of an interest rate you had, it may create where some of that income was taxed. But being able to capitalize on that 0% tax rate is important in an installment sale. Now, the bad side about the installment sale is you have to understand that you're the one taking the risk there. And so you have collateral of getting that business back or getting those assets back. However, if that sale continues on down the road, and let's say you're 3 years, 4 years into it, you may have that business back, but in what shape is that business when you get it back? How valuable is that asset?
Ran it into the ground.
Exactly.
Okay.
Exactly.
Okay.
So that's kind of the
there's a risk reward there.
Exactly.
Then, right?
Exactly. But a lot of times you're able to find a purchaser that maybe has some challenges in getting financing. Now, in and of itself, that should be a concern to you as a seller. But let's say that you vet those and you're comfortable with that. That maybe becomes an opportunity for you to sell the business that maybe wouldn't otherwise be there.
Sure. I think a lot of times these closely held firms are sold with some level of an installment.
Exactly. And what we see a lot of times too is, let's say there's a buyer of a business who, newer to the operations, but gets an SBA loan.
Yeah.
And that SBA loan is, backed by the government.
Right.
And so the bank is willing to loan that money through the SBA. However, maybe that's not the entire purchase price, or purchaser needs to put some money down of their own, and they don't have that money to put down on their own.
Yeah.
So what then happens is the seller will maybe work with them to sell part of it on the installment method, and the bank paying for the other part purchased up front. So you could still have
So
an
it's kind of a
installment sale.
holdback? Is that what I've heard that term
well,
used as, or not?
I wouldn't call it so much a holdback, but it's
Okay.
just there's a portion of it that's being financed by the seller, but a good portion is being financed by the SBA in this
Okay.
particular case, or any bank loan.
Sure.
You know, it doesn't have to be an SBA loan, but it could be any bank loan. But it's a combination of the two, where the bank becomes more comfortable that they're not financing 100% of the purchase price.
Yep.
They're financing, say, 80% of the purchase
Sure.
price, and the other 20% is a combination of money that the buyer's putting into it, or that the seller is financing themselves.
Taking a backup position to everybody else.
Correct.
Okay.
In the state of Iowa, and I think everyone on this call would be probably in the state of Iowa. Is that correct?
Yep.
Okay. So in the state of Iowa, we have what we call an Iowa capital gains deduction, and that's an Iowa incentive, tax incentive. So, you know, really, as we look at it, as people age and they start to sell their businesses or their assets, having them stay within Iowa, it's attractive for the state to have them be in Iowa when they sell that, and they're going to give a Iowa capital gains deduction that they don't have to pay tax on. So what does it, what falls into that category?
Yeah.
Basically what we have is, it would be a capital gain from the sale of a business or real estate in which the taxpayer had materially participated for 10 years. And that property would have been held, or that business would have been owned for a minimum of 10 years prior to the disposition. So let's say
the sale?
The sale, yeah.
Okay. Big words here, Chad.
Well,
Come on.
when I say disposition, the reason I said that is because it could create through a liquidation as well.
Oh.
And so if you had a business that
Forced
liquidated,
liquidation?
if you have a forced liquidation, you're probably not going to have a gain. So you
Very
probably
true.
don't need to worry about
All right.
that. But if you liquidated it and you had a gain on the liquidation, it could still create an Iowa capital gains deduction.
Okay.
So to that point, let's say that, you know, again, you had the sale of the business, and through an S corporation or an LLC, you had Goodwill that was created and you sold. That gain, if you met this 10-year holding requirement and this 10-year participation requirement, you could back that gain out on the Iowa tax return so that it's not taxed on the Iowa tax return.
Okay.
And so in essence, you know, you had a $100,000 Goodwill gain that goes untaxed in Iowa. And, you know, while Iowa rates aren't as high as the federal rates,
Sure.
it certainly adds up. You know, we're at a maximum rate for Iowa is 9%, 8.98%. So, you know, it certainly adds up, and it's something you want to take advantage of
Sure.
if you're able to. Now,
is there a cap on how big of a?
There's no cap on how big, but there is a capital gain from the mere selling of a stock does not qualify.
Okay.
So in that particular case, you're not eligible for the Iowa capital gains deduction. But again, through the liquidation, if you had an asset sale through in an S corporation, or you had an asset sale of a LLC, through the liquidation of those entities, the S corporation is where it would really apply. You could then have a gain at that point that could be eligible for this Iowa capital gains deduction. So again, it's one of those things I want to make sure everyone's aware of. It's one of those items that kind of falls under the radar because it's an Iowa only tax benefit. However, with that being said, the recent tax legislation, Iowa legislation, they have a new plan going forward. And so if the Iowa revenue targets are met going forward, there's different levels that they have to achieve. That Iowa capital gains deduction will be severely cut back in 2023 to the point where really the only thing that would qualify would be real estate used in a farming business at that point. So while we have these 5 years here, or 4 years,
sell now.
Yeah, it's something to certainly look at if you're selling a business and be apprised of and not lose sight of and not be able to take advantage of it.
Okay.
Another item that we talked about, and again, I know that there's going to be a separate session on ESOPs, I believe, but is ESOPs. And ESOPs are gaining popularity. When we talk about an ESOP, basically what it is it's a tax-exempt entity, but it's really a qualified retirement plan. And so it is owned by the individual employees of that business. So They get stock on an annual basis based on how much money they're making, in essence, relative to how much the other employees. And so there can be stock they're earning each year as a result.
Okay.
So it's very powerful, in business, and business owners are really attracted to it because they feel it keeps the employees engaged. Another piece why it's important to business owners is because keeping the business in the area in which it's located
Sure.
is important. Instead of selling it to the highest bidder and that business being swallowed up by a company in Ohio or California or wherever the case may be, it helps to ensure that that business is going to stay there because those employees are going to stay there.
There's a big legacy component.
Exactly. Yeah. And along with that, those jobs are going to stay there as well, instead of being consolidated and jobs being eliminated.
Yep.
So people who are interested in ESOPs, that's generally what they have as a background there.
Okay.
So to that point, if you're a C corporation and you sell to an ESOP, that is attractive because you can then defer the gain that you would have on that stock sale, because it's a stock sale to the ESOP.
Okay.
You can defer that gain to the extent you take those proceeds and reinvest those in publicly traded securities.
Okay.
So, let's say that, you sold the business and you decided, I'm going to put all my money, I wouldn't advise this, but I'm going to put all my money with Apple, and I'm not saying that against Apple. I'm just saying against diversification.
Yeah.
But you put all the money with Apple. So say you sold it for $500,000.
Okay.
You had $100,000 of basis in it. You had a $400,000 gain that you're pushing down the road, you're deferring by purchasing publicly traded securities.
Okay.
You now have $100,000 of cost in those securities, though. So whenever you sell those, you're going to pay taxes on it at that time.
Okay.
But you've pushed that out.
And then you can sell it over time in smaller quantities.
Correct. And then you can control your gain as a result.
Okay.
Exactly right. Now, in the case of an S corporation, there's attractions there also from the ESOP perspective. An S corporation that has an ESOP as an owner, that ESOP, again, I mentioned earlier, is a tax-exempt entity.
Right.
So as a result, in an S corporation, that profit passes out to the individual owners of the owner in this particular case is the ESOP, the tax-exempt entity.
Okay.
So that income that's allocated to them, they can go without paying taxes on it. It's tax-free to them. So what does that do? Well, it allows the money to stay in the business and, stay in there for capital.
Yeah.
Be able to give the individual owners additional shares of ownership in the company, perhaps through the ESOP. And it also, if the seller has sold it on contract to the ESOP, it also ensures that there's going to be more cash flow in the company instead of some of it going to taxes to help ensure that you're going to get paid as you're getting those installment payments.
So it can be just as popular and attractive in an S corp situation.
Exactly.
So?
Yep. Exactly right.
Okay. No need to switch from one to the other to go through the ESOP process.
Yeah, I mean,
maybe certain circumstances.
Certain circumstances. It definitely needs to be looked at, but there's probably reasons why you've been a C corporation, or why you've been an S corporation that still lend itself to staying that way.
Okay,
is what I would say to that.
Okay, perfect.
All right. So another item that I mentioned earlier is gaining popularity with the new tax bill. Under the new tax bill, there was a big change in the taxation of C corporations. C corporations used to be taxed at a graduated tax rate, meaning the lowest rate was 15%, then it moved to 25%, 34%, to as high as 39%. And so as a result, that double taxation, when you're paying as high as 39% inside the company, and then another, maybe 23%, all federal taxes here, on top of that to get out, that is certainly onerous, and it was never, most closely held businesses,
tax efficient.
Exactly. And most closely held businesses that we work with are either S corporations or LLCs as a result of what the past tax rules were, that double taxation. Well, under the new tax bill, we still have the double taxation. However, what we do have is we have a flat rate now in C corporation world.
Okay.
And that flat rate is 21%. So if your income is typically $50,000 or less, you would not benefit under the new C corporation because it's now 21%. However, if you had income of over $100,000 and you were being taxed at 39% on that amount over $39,000, under over $100,000,
Yep.
you're now being taxed on that at 21% instead of 39%.
Okay.
So obviously there's an attraction there that takes away a little bit of that double taxation as a result.
That's why we've had all these seminars and workshops this year from
Correct.
folks like yourself talking about, is it time to reconsider the C corp?
Exactly right.
Okay.
Exactly right. So if you go that C corporation route, though, what has been an underutilized provision of the tax code, again, because there's been very few C corporations, is what we call the Section 1202 stock.
Okay.
And what that is it's the ability to exclude that gain on the sale of stock if you meet certain criteria on the sale of that C corporation stock. That criteria would be, it'd have to be an original issue stock, meaning that you would have received that stock when you formed the company,
Okay.
or you would have purchased it directly from the company. If you bought it from another individual, that's not original
So we're
issue
talking
stock.
about the founder owner here,
Correct.
right?
Correct.
Okay.
Typically, that's what you're going to talk about.
Okay.
It has to be a qualified trade or business. Generally speaking, a service business does not qualify for this.
Okay.
And then the stock must have been held for at least 5 years.
So what is an example of a qualified trade?
Well, if you were like a manufacturing construction business, those would certainly fall into those type
employment heavy type of industries.
Correct. I mean, more that are less service based,
Sure.
but more creating widgets or selling widgets.
Okay.
Or,
So my
doing
lemonade
things like
stand probably isn't going to fly. There, huh?
well,
Unless we're manufacturing lemonade at a very high.
it's probably going to
Okay.
be considered a service business. But,
Okay.
I haven't really looked at a lemonade stand to see
That's
if that
all right.
would, but
That's all right.
that's an interesting question. So to that point, if that stock was acquired, again, it has to be held at least 5 years, but if that stock was acquired prior to February of 2009,
Okay.
there was a 50% exclusion of that gain.
Okay.
Then there was a period of time from 2009 to 2010 where you had a 75% exclusion of the gain. And then since then, it's 100% exclusion of that gain. So, where else are you going to be able to provide 100% exclusion of the tax than in this 1202 stock? And so it's something that certainly has merit as we go forward in setting up C corporations and the attraction to C corporations. But again, all of these factors need to be looked at in the totality. There's certain factors here that are going to be more beneficial to one entity versus another. But this is just something that's important to keep in mind, especially if you're already a C corporation and meet these criteria.
Is there an opportunity for those in an S corp or other pass-through entity to ever consider, or the benefits outweigh the disadvantages to move into a C corp because of this? If they're the original founder owner of the company, or is that kind of getting off track?
No, there certainly are different situations that would lend itself to going back to a C corporation if you're an S corporation.
Okay.
And that's something that we're looking at with our S corporations right now. Is does it make sense to go back to be a C corporation?
Sure. What are some of the criteria you're evaluating to look at that?
Certainly, the criteria are potentially age of the owner. Exit strategy. Whether they have a plan in place where maybe other employees are going to be buying the stock, as opposed to having to worry about whether it's going to be an asset sale or not. Other factors would be just the pure taxation of it, both on an annual basis and on a liquidation basis. What would those taxes look like? Okay. And then thirdly would be the capital needs of the business. If it's a capital intensive business, the C corporation is probably more attractive while the business is operational, because you're keeping the money within the business. Correct. If you don't need the cash flow, the S corporation is probably still more attractive because you can pull that money out without the additional second level of tax. And then you don't have to worry about getting that money out like you would in a C corporation. Later on, so there's many factors, but those would be some of the factors that we would certainly look at.
Okay.
Other considerations that we discussed in kind of the summary were the sale of personal goodwill. So again, that would result if you had a personal service business.
Okay.
And let's use an accounting firm as an example,
Okay.
or an accountant, a CPA.
Mm-hmm.
That CPA, maybe it's an individual business,
Sure.
individual owner, but owns it in a corporation or a LLC
Yep.
environment. In a corporation, C corporation, that can become a big deal because, first of all, identifying part of your sales price as being personal goodwill, meaning that seller had that name recognition. They were the business. When they see that corporation, Dan Binkin, PC,
They're one and the same.
they know that Dan is the owner of that. And
Okay.
Dan's the one that does the work.
Okay.
So in that regard, if we allocate some of that purchase price to personal goodwill, not only do we avoid the double taxation, but it comes out to you and it's going to be taxed as capital gain property, and you're going to get
Sure.
that favorable tax rate as a result.
Okay.
So that's something to consider, especially if you're in a personal service corporation.
Is that where a PC would
Yep.
benefit too?
Yep.
And I don't
absolutely.
know, are those still popular? Or?
PCs are definitely still something. I'm going to say they're popular.
Okay.
As we move back to more C corporations with the new tax bill, they will become more popular.
Okay.
But in recent years, they haven't been as popular,
Right.
C corporations, PCs. But they will become more popular, and being able to take advantage of this when you get out of the company would be something to
You're
keep in
looking to
mind.
sell if you're thinking that long term.
Absolutely,
Okay.
absolutely.
Great.
Another item.
Oh, I'm sorry. I guess we got a question here quick. How much time do I need to allow when starting succession planning? I have kids that are just starting in my business. I'm thinking succession is still 10 years down the road.
How I would answer that is I would say it's never too early to start thinking about succession planning. Obviously, you're going to fine tune it as you get closer, to those 10 years down the road.
Mm-hmm.
But it is not a disservice to think about it at this stage because, those kids, if you're thinking that they may take over the business, well, how do you get them brought up to speed to understand the business? Or if you're thinking of selling it to someone outside, what can you do to make that business more attractive? Like we were talking about the maximization of the sales price earlier.
Mm-hmm.
What can you do to make that business more attractive so that as you have that history of performance, it's going to be at its best possible time to sell and take advantage of it. So
from a tax strategy standpoint, how does...
Well, from a tax strategy standpoint, what I would say is that I think everyone probably understands that we're dealing with tax rules that can change each year. And so what we do is we deal with what the rules that are in front of us.
Okay.
And some of those rules will still be here 10 years from now. Other rules may not be here from now. But again, I think given the deck that we've been dealt, you need to think about that and plan for that and try to get the company, set up to take advantage of what there is. Because if we wait, some of these functions, some of these items that we've talked about have a period of years that you have to have in place before you can take advantage of it.
Sure.
And so if we wait too long, we're not going to be able to meet a 5-year holding requirement or a 10-year holding requirement or whatever the case may be. So I think it's always something that needs to be thought of. It certainly maybe isn't as top of mind as maybe what it is 5 years from the time you're going to be exiting or 2 years from the time you're going to be exiting. But I think it always needs to be out there and be a concern.
One thing with Brad's question, about family-owned companies maybe is oftentimes I hear about, well, I'm transferring shares to the kids type of thing over time or whatever. Does that imply then that they're doing a stock sale of the company or not necessarily?
If they're transferring, it may not be a sale. It may be a gift.
Okay.
They may pass away with the stock and leave it to their heirs as well.
Okay.
And there's a little bit I have later in here that we can talk about that when we talk about the age of the owner.
Okay.
That becomes an important piece to consider as well.
I'll let you keep going. Okay.
So another consideration is having a complete liquidation in the year of sale.
Yep.
And so what I mean by that is it would take place when we have an asset sale. So let's say the assets are sold, but that company still exists. The company that you held those assets in still exists until you liquidate it.
Sure.
You may not want to liquidate it. Maybe you want to buy another business with it, now or on down the road. Maybe you want to do a gradual liquidation to take advantage of some of the tax benefits of spreading that income out on the liquidation, like we talked about earlier. However,
sheltering yourself from higher income brackets.
That's correct. That's correct. However, many times there may be a loss that can be generated in the complete liquidation of the business that can then be used to offset the gain that maybe was generated from the sale of those assets.
Okay.
So let me try to illustrate this.
Yeah.
Let's say you had the Goodwill gain again of a capital gain.
Mm-hmm.
When you liquidate your S corporation or it'll be an S corporation in this particular case. When you liquidate that S corporation, that may create a capital loss as a result. Well, individually, capital losses, your net of capital gains and capital losses cannot exceed $3,000 in any one year. That's all you can take as a deduction in any one year. The rest gets carried forward to future years. So let's say that you sell business here in 2018. You have a gain from the sale of the Goodwill.
Okay.
You get taxed on that in 2018 because it flows through to you on your individual tax return if you're an S corporation.
Yeah.
And you don't liquidate the business until 2019. Let's say that at liquidation.
You say we don't liquidate the business.
Well,
we've sold the blue sky already, right?
Yeah, we sold the business, but we haven't liquidated the corporation, the S corporation.
Okay, I got you.
So
the
shell is still in place.
Okay.
So in 2019, we liquidate the S corporation at that time.
Yeah.
There may be a loss there, and let's say that loss is $50,000.
And that loss could be due to we paid more for the property than it was worth when we sold it?
Correct. And
how are we having losses and gains on the same essential
without getting too deep here, what can happen is that gain in an S corporation, the taxable income inside the corporation adds to your cost basis.
Okay.
And that's what prevents you from having double taxation.
Okay.
So if you have that money in there, but the cash flow that you're going to distribute is less than what the basis is in there, it can create a loss. And so if we have that loss in 2019, not only did you wait a year that you weren't able to take that $50,000 against that gain that we had on the Goodwill sale, you may be limited if you have no other capital gains to only deducting $3,000 a year on that $50,000 loss for the next
20 years. Right?
Exactly.
Okay. All right,
so
cool.
That's where if you have a sale of business, you want to look and see if you're a flow through entity, does it make sense to get out of your entity entirely and liquidate it and be done with it.
Okay.
Another item that I talked about earlier was a structured S corporation redemption. And what that is if any of you are S corporation shareholders, you will understand that distributions from an S corporation, distributions of profits, and again, what the attraction of the S corporation is that it's tax-free to the extent you have income.
Yeah.
They have to be pro rata. So if you have multiple owners in the business, those distributions have to be pro rata. So dad cannot receive more than mom if they're both 50% owners, or son and daughter, or whoever the case may be.
When
they
you're
have to be
talking
pro
about
rata.
Just sorting out the incomes out of it, right?
Correct. So let's say that there was $100,000 of bottom line profit in the corporation. And let's say that they're comfortable in distributing $50,000 of cash that year. That $50,000 is tax free, but it has to be distributed pro rata based on the ownership. So
at the corporate level.
That's correct. And individually.
Oh.
At the corporate level, that $100,000 was taxed.
Okay.
But to get that $50,000 out to them individually, that is tax free because there's no double taxation in an S corporation.
Okay. They'll end up paying for it on their income taxes as individuals, though, correct?
The $100,000, because that income flows through to their individual return.
I got you.
That's correct.
Okay.
So with an S corporation, with a structured redemption, what will happen is we will purposefully, there's a plan in place to have disproportionate distributions to the outgoing shareholder. So what that allows us to do is it allows us to apply those distributions, and that extra distribution is part of the purchase price, part of the sales price of that outgoing owner.
Mm-hmm.
What it allows us to do is it allows us to take the basis that that individual has in the S corporation
Okay.
and offset that against the proceeds first, so that you may have a period of years or
Sure.
a year or multiple years where you're getting money out of the company and it's tax-free to you. And then the tax is all back end loaded as a result.
Mm-hmm.
But you're pushing that tax out as long as possible in that particular case. And that needs to work in a family environment. So it needs to be a family business where you're paying mom or dad to get out of the business through this structure.
Yep.
And then daughter or son are taking over and they're continuing the business going forward.
Okay.
But that's an example where that would work.
Okay.
The last item I had, and Dan, you had brought it up earlier as far as kind of estate planning goes,
Mm-hmm.
Age of the business owner. And in the age of the business owner, what I'm going to throw out for consideration is if that business owner is perhaps aging in years, maybe health is not real great, if they don't need the proceeds from the sale of that business, you may very well be better off to have them hold it until their date of death. And the reason that is because the beneficiaries can get a step up in basis of that property. So what that means is that if dad were
So if I'm an old fat guy,
yeah,
all right, I'm type 2 walking around type of thing,
sure,
and my kids might say to me, you know, or I might say to my kids, I think it behooves me to hold on to this thing until I kick off.
correct. Obviously, you maybe have son, daughter already involved in the business, maybe
Yeah.
the day-to-day operations,
Sure.
you're not missing a beat.
Yeah.
So assuming the business
totally
can
planned
continue.
that this is
Yep.
going to happen this way.
Exactly. So and if dad and mom don't need that income for that cash flow
Yep.
for them to live going
Yeah.
forward, they may be better off to hold on to it because the estate exclusion now is up to $11.2 million per
Per person.
individual.
22-4 combined.
Exactly. So with that, there's a lot fewer businesses that, first of all, are subject to estate tax than what there used to be in the past.
Sure.
In the past, we used to look at this and we used to try to have mom and dad maybe consider gifting some ownership
Right.
to daughter and son over time to get it out of their estate to avoid estate taxes.
Yep.
Now, with the estate exemption being higher, there's fewer businesses that need to do that. And so to that point, if they're not going to have any estate tax as a result, hold it until their date of death, daughter or son get a step up in their basis, meaning a step up in their cost of that company. So if they then turn around and sell it for its fair market value, which is what it would have been stepped up to, the cost, you in essence have a no gain or loss as a result of that. So let's say, for instance, let's say dad's put in $10,000 for a business that is now worth, let's say, $100,000.
All right.
So there's a $90,000 gain in there if he were to sell that business.
Yeah. Sure.
All right. Dad holds it until he passes away. Daughter, son, whomever inherits that. They now have a cost in that stock of not $10,000 like dad did. They have $100,000 because it stepped up to the fair market value on the date of death. So if they then turn around and sell that stock,
evaded a bunch of tax there.
Exactly right.
Okay.
So if they turn around and sell that stock, they now have zero gain, zero tax to pay. Now, if they hold on to it for 5 years, it may then appreciate from $100,000 to $200,000, but they still eliminated $90,000 a gain as a result. So that's where you kind of have to look at what the needs are of mom and dad in the business, whether the company.
So if they're living comfortably and great already and the business is done well by them, et cetera, this is
this is one
likely
piece
scenario.
There's a lot of factors again that go into it. One is, maybe daughter and son are sitting there going, I understand why you're doing this. I don't think the tax piece is that big of a deal. I think it's more important for us to be on our own.
Say we're the owner.
You take the training wheels off, let us go, and we'll reap the benefits and suffer the consequences of the actions that we take going forward.
Okay.
So there's many factors that fall into it, but from a pure tax standpoint and from an exit strategy, if you're looking at this and mom or dad are considering what's the exit plan, it's something that needs to be considered.
Okay.
Because of the fact that you can avoid taxes as a result of it. So.
And even if you're not planning to sell as soon as dad kicks off type of thing, you increased your basis to whatever that new market value is at the time of his death.
Correct.
Okay.
Now, another reason why maybe mom or dad would want to dispose of it is maybe they want to, when you get to be 70, 65, 70, you're starting to think about, okay, I have all my eggs in one basket. Maybe throughout their lifetime, they've had everything that they've ever had in their possession put back into the business. This is a way to take the risk off the table and then diversify. You have a privately closely held business that certainly, even your best companies, there are certainly risks that are involved with that.
Sure.
So that may be a reason that mom and dad may want to take that,
maybe they don't quite trust Junior all the way to be running it anyway, or something, whatever it might be.
So that's why I say there's a lot of factors that fall into it,
but
it's something that needs to be considered.
Okay.
So, let's see here. So I guess with that, I would open it up to any other questions that there would be. And I realize that some of those topics we may have gone over quickly or maybe didn't explain as clearly as maybe what you could comprehend. And so I'd be happy to go back to those or answer any questions you might have. Okay,
yeah, definitely. If we have, it's basically 1 o'clock. We try to end on time, but if folks are still with us that have a question for Chad, please type that in here and we can address that now. That'd be great. Otherwise, we'll let you all have a great afternoon, and we learned a little something here about how to avoid Uncle Sam, so to speak, I guess. Anyway, thank you.
Thank you all. Appreciate it.
Off the top of your head, do you know when the next webinar is? Put you on the spot here, Dan.
It's a great question. I don't know that I know off the top of my head.
Do you know the next topic? I'm looking it up really fast for you.
Okay, I do know that later this week on Friday, we are going to be having our first family business forum. And so we work with a lot of family-owned companies, and we're getting those families together on Friday down in Ankeny at 8 o'clock. And if you could join us, learn more about succession planning, how to deal with generational planning and leadership, family conflict, etc. We'd love to have you as a part of that. You can check that out on our website. Maybe we could put that into the chat box here.
Yep, and our next Advanced Iowa webinar is October 23rd. And the topic is very similar with the Family Business Forum. It's family succession, transitioning with GAP leadership.
Oh, yeah. Okay, yep. We're going to be talking with a company that's using a GAP leader to kind of fill a bridge, so to speak, between an owner who's kind of ready to retire out and a son who is a little younger and maybe not quite ready to take over. So they're utilizing what's called a GAP CEO transition plan. Yep. And so we'll be talking to that. Yeah. So thank you all for joining us. Thank you, Patrick. Thank you, Chad.
Yeah. Thank you. Appreciate the time.
Yeah. Appreciate it. Yep. And we'll close this up and everyone can have a great afternoon. Thank you.
And